Hi, welcome back. We're moving on in our market equilibrium unit by focusing now on the effect of government intervening in the market. And there are a number of interventions government can use, but in this course we're just going to really focus on one main one, taxation, and particularly indirect tax. So first we'll briefly look at direct taxation, which is fairly straightforward because it's about changes in income. But indirect taxes are taxes on goods and services. And so this will require a little bit more analysis. And so that's what we are going to focus on through these slides. I hope you enjoy. Now we're going to look at the government intervening in a market, government interventions, and we'll analyse first these interventions looking at changes in revenue. Now, the only government intervention that we're going to look at is tax. Income tax is an indirect way of affecting a market, and a sales tax, a tax on goods and services, is a more direct way of influencing how much is produced and consumed. So let's first look at income tax. There are two main types of taxes. Taxes called direct taxes, which are taxes on income. So therefore, the demand curve will change when income taxes are changed. The demand curve will shift to the left when income tax is increased. Consumers have less income, so the demand curve will shift left. And of course they'll shift right when income tax is decreased. Indirect taxes are taxes on goods and services. So they affect costs of production. An indirect tax is paid in part by the producer, so it's a cost, as we've already seen when we looked at the supply curve. So it affects the supply curve. So the supply curve will shift left when GST is increased. It will shift right when it's decreased. So this task is focusing on a change in income tax. Income taxes increase. So consumers now, purchasers of tractors, have less money to spend. So we know the demand curve is going to shift to the left. How far left? Well, you're told that there's a decrease of 100 tractors being produced at each price. So we know the demand curve is going to shift this way by 100 units. And we can take it at any price, it's going to shift left. So from our original price of 30,300 units, we're producing 100 less. So we can draw a new demand curve like that. There's now a surplus in the market at 30,000. How do we know? Because we know that quantity supplied has not changed. It's still 300. But we can see quantity demanded has decreased because farmers have less money to spend on tractors, because they're paying more income tax. So how does the market deal with the surplus? Well, we know if there is excess supply or surplus, the price must decrease. And as the price decreases, we know that according to the law of demand, quantity demanded will increase and quantity supplied will decrease. So this slide is the explanation of what's happened in the previous graph, and so I'll leave you to do that, and we will review that in the next teaching session. Now we move on to look at the effect of an indirect tax. The most common known as a sales tax, and this we're going to spend some time on because it's our main government intervention graphical model that we're going to study. Now remember, a sales tax is placed on goods and services. It becomes a cost to the firm who sells the good. Therefore, the supply curve will shift up by the amount of the tax per unit. At the existing price, there will now be a surplus, so the price will rise. How much it rises depends on the relative price elasticities of supply and demand. Nonetheless, the price paid by the consumer will also rise, except in one situation. If you want to watch these videos, again, they're excellent introduction with lots of detail, so don't hesitate to look at them. Okay, now what we're looking at is the market for salt, but more particularly we're looking at the market for salt that's sold in shakers, small containers. And we're told in the introduction part above that the government places a sales tax of 50 cents on each salt shaker that it is put on the market to be sold. So we know that the tax per unit, that's the tax on each salt shaker, is equal to 50 cents. So in this way we know that the costs of production for the business has gone up by 50 cents per unit for each salt shaker. So we can increase or raise the supply curve by 50 cents per unit at each quantity, as you have seen. And so we can now plot our new supply curve being near. So the vertical distance measured by this here represents the per unit tax, how much the tax is on each item sold. We move the supply curve up as a parallel line because the tax is the same on each salt shaker. Now the price rises. Why does the price rise to $1.50? Well, let's look at the existing price of P, or $1.25. We have a situation. So let's identify the main points of the graph. We know the supply curve will shift left because the sales tax increases costs of production, and the market price will increase to $1.50. The market quantity will decrease to 200 units. So what do the following letters represent? P, of course, is the original price before the tax. PC, the new market price paid by the consumer. PP, the effective price received by the producer. Even though they receive PC, price paid by the consumer, but of course the government's going to take the difference, PC minus PP, the amount of tax, away, so the producer is effectively left with a price equaling PP. Q, of course, is the market quantity before the tax, and Q dash the market quantity after the tax. The significance of the two curves being parallel, of course, is that the per unit tax is the same on each salt shaker. It's 50 cents. So as we've seen, the supply curve has moved up and become S plus T by the amount of the tax on each salt shaker, on each unit. So we can measure the value of that by reading across to our price line, and we can see that $1.50 minus $1 is 50 cents. So the per unit tax is 50 cents. The consumer was paying $1.25 and is now paying $1.50 because of the tax. Now, consumers actually spend, consumer expenditure is equal to PC times 200. or total revenue, because it goes initially to the producer. But of course, the producer doesn't get to keep all that, because the government's going to take its share of the revenue in tax. And so that new red rectangle represents the amount taken, which is PC minus PP, or 50 cents for each salt shaker per unit, times the quantity that is purchased. Now remember, the per unit tax is 50 cents, or total tax is 50 cents times 200. Now consumers pay some of the tax and the producers pay some of the tax. Let's see how much each one pays. Now the consumers were paying $1.25. Now they're paying $1.50. Therefore, their share of the tax is 25 cents per unit, or 25 cents times the quantity purchased. Whatever the part of the tax the consumer doesn't pay, the producer will pay. The producer will pay the rest. So in this particular case, it's equally shared. But that will vary depending on the relative price elasticities of demand and supply, as we shall see when we look at the incidence of the tax. So to summarize, using the graph, show you working, total revenue from sales after the tax is imposed is $1.50 times 200, $300. Tax revenue collected by the government is 50 cents times 200, $100. Consumer's share of the tax paid is 25 cents times 200. Producer's share is the same. Producer revenue after the tax, $1 times 200 equals 200. So of the total tax, $100 is collected by the government. Consumers pay 50, so producers pay the other 50.